model for its deliberations on interest rates. The quarterly projection model was introduced towards the end of last year. We spoke to economist Azar Jammine about what the model does and whether it can be more consumer friendly and provide for indebted consumers some interest rate cuts. Let's listen to that.
Central banks across the globe use macroeconomic models to help frame their minds on inflation and their course of action in terms of monetary policy. The latest quarterly projection model used by the Reserve Bank is expected to produce better forecasts for the country's economy and therefore better inform the Monetary Policy Committee's decisions on rates.
Essentially, when the Reserve Bank actually decides on interest rates, it gathers all the information together and forecasts a lot of the variables that might influence interest rates, puts them into a model and forecasts from that model what the inflation rate is likely to be, and also it's got a probabilistic forecast which tells it what chances are that the inflation rate will turn out to be that much higher than its central forecast or that much lower.
Unlike before, the bank's new model also follows the US Federal Reserve's example of forecasting how many interest rate cuts or hikes may be possible over a given period of time. On the strength of this model, the Reserve Bank has signalled that rates could go up by 0.5% by the end of 2019. But ultimately, what value does this new model give to broader society?
I suppose the value that it gives is, for example, in the current situation, inflation is actually lower than people had anticipated before. The rand is very strong, and everything says that, wow, it's a wonderful opportunity to reduce interest rates. And what this tells people is, wait a minute, don't go there too fast. Even if the inflation is falling right now, the model suggests that it might be that much higher in a year's time, and that interest rates therefore in a year's time might need to be that much higher, and therefore don't necessarily bank on a cut in interest rates right now.
But some would argue that with the country's current low growth levels, the bank should be less conservative and consider rate cuts to inject some liquidity into the economy.
I don't necessarily think they're being too conservative. I think they're being very logical. It's just that they're being pressured. I think the majority of players and analysts want quick fixes, and there are no quick fixes in economics. I think the Reserve Bank's very sensible in its approach right now, and all it's trying to do is to reduce the shock value of whether it cuts or does not cut.
Jammine echoed the mantra of the Reserve Bank, which says the interest rate tool is not an all-in-one fix for the economy, and that structural adjustments in the economy are desperately needed, particularly in areas like education, which, if dealt with decisively, could turn the fortunes of the vast majority of South Africans around. But of course, many of the things that need fixing, be it education, corruption, infrastructure investment, for example, won't be solved overnight. Nompumelo Siziba, SABC News, Johannesburg.